China is prepared to protect the yuan against the collapse of the current fiat currency system. I mean, the fact of the matter is that gold is money and all the rest is credit. China understands this. And indeed, I mean, it was interesting because I'm speaking at the New Orleans Investment Conference in October. Egon von Gretz very kindly sent me over some slides which he uses. And one of them I found fascinating, I wasn't aware of before. And that is that in 1971, when the Bretton Woods system was ended by Nixon, China condemned the move as being, I can't remember the words, but basically they said this is completely wrong, etc., etc. So they understood, even under communism, that's the only way you can anchor the value of a fiat or a currency is to have it as a gold substitute. In other words, it is readily exchangeable for gold. Now, that was never quite the case under Bretton Woods, but, this, if you like, informs us about China's attitude, which continues through to this day. As to the comments that you repeated from Matthew's article about, how the retail market's selling it and they don't understand, the whales are buying it and so on. I mean, China has always used market dips, drops in market sentiment to quietly accumulate gold. They're not price sensitive. What they are sensitive to is the availability of the stuff. Yeah. And if idiots want to sell it, they buy it. And I had something interesting the other day. Ross Norman, who I have great respect for, I mean, he operates within the LBMA. And in the past, he's admitted to me he doesn't know anything about it. He doesn't study economics or whatever. He's just a market man. And he was asked in an interview who bought Gordon Brown's gold back in 2000, 2002, whenever it was, when we sold something like 700 tons of our gold. And he said, China.
What?
It doesn't surprise me. I mean, I've been, writing about China's approach to this for well over a decade now. And but I hadn't actually understood that particular little morsel. But China is still doing it. And if some idiot outside in the West says, the bull market's over, peak gold, I got to sell, we'll try to say, gimme. And that's what they do. That's what they do. Because they know that gold is money and the fiat currency, which you account in, is just credit. And we're now in a world where you can see that the value of credit is becoming increasingly unstable.
Beijing hasn't just been buying gold, it's been quietly building out the infrastructure to price and settle it entirely outside Western control. Hong Kong has launched a new gold clearing and settlement system backed by the city government with a dedicated seat for the Shanghai Gold Exchange and is racing to expand vault capacity roughly tenfold toward more than 2,000 tons within 3 years. In July 2026, major Chinese banks reportedly began phasing out easy paper gold trading for retail clients in favor of physically backed settlement instead, alongside reports that China told domestic banks to trim their exposure to U.S. treasuries. Taken together, the pattern points to a country preparing an entire alternative financial architecture, not simply stockpiling a commodity.
I would agree with you. I would have modified it slightly and say they're not actually telling us anything because they
I know what you're saying. Yes. Okay.
But as to the point, more less frivolously, I mean, central banks are the ultimate insiders. And the ultimate insider of the insiders is obviously the People's Bank of China, because they basically are driving the market. Now, not only have they been cornering the market, but now they are setting up in Hong Kong the alternative, if you like, to Western capital markets, the paper market in London, and also the futures market in New York. It's absolutely clear. I mean, you can just literally since Trump's Independence Day, April 2nd last year, you can see the footprints of exactly what's happening. I mean, first of all, China says, right, we're doing new vaults in, for gold for people who are prepared to swap yuan for gold and gold for yuan. We're going to build a vault in Hong Kong, which we've now done, and we're also going to build one in Saudi Arabia, which of course was a huge, great payment settlement area as far as China is concerned, and as far as other nations are concerned, because of the oil and energy exports from the region. So that was the first thing. And on the trade side, a little bit before that, President Xi did a whistle-stop tour, literally the week after April the 2nd, round Southeast Asian nations, basically the principal members of the ASEAN trade bloc, to discuss trade. Now, we're not privy to the conversations, but one thing you can be sure is it's not just trade that she was talking about, but trade settlement, because the two topics are intertwined. So that was the first thing. Then the vaults were the second thing, and then more recently we had, I think it was in February, China told her commercial banks sell U.S. treasuries. What? Yeah. Really? Why? I mean, she said, something banal like, don't have too many U.S. treasuries because we think that they're going to be too volatile. Yeah, which actually basically is saying, sell the bloody things.
Yeah, yeah,
so
yeah.
That was that. Now, she then announced that she was setting up, if you like, a far larger vault facilities in Hong Kong and dedicating refining in Shenzhen for this new expanded market. And she set up a precious metal settlement system, which actually was modeled on the one in London. So, you can see that she's just preparing the market. Now, the last thing she did, which I think is actually a lot more exciting than people would think, is that there was a very, very, if you like, it's a sort of announcement that flies under the radar. The People's Bank said that if you wanted to export gold, instead of having to get the permission from the PBOC and customs, you needed only clear it through customs. Now, this is major. This is major because it means that, if you like, there's a chink of light in exchange controls. That's the first thing. Probably indicating that exchange controls at some stage will fall away. It also indicates that, if you like, you've got the changes, if you like, in the relationship between Shanghai and Hong Kong. The two are fusing in terms of markets. And the other thing I forgot to mention is that she turned around and said, right, we're clamping down, and this was actually the commercial banks, we're clamping down on leverage positions in gold and silver. This is for people who just sort of want to leverage up and all the rest of it.
Similar.
But at the same time, this market was moving offshore into Hong Kong. So you can see that the structure of the whole thing was changing. But I think the most important thing to realize is that the end result of all this will be China putting her yuan on the gold standard in order to protect her from a collapsing fiat currency system.
Veteran market watchers say a common misreading of the current gold rally is treating rising prices as gold becoming more expensive. The more useful framing flips that around. It isn't gold moving, it's currencies losing ground underneath it. Central banks worldwide bought roughly 850 to 1,000 tons of gold in 2026 alone, according to World Gold Council estimates, with newer buyers like Poland, Kazakhstan, and Indonesia joining longtime accumulators like China and India. The dollar share of global reserves has slid from over 70% in 2000 down to roughly 57% today. Seen through that lens, gold isn't really the asset investors should be trying to time. It's the benchmark everything else is now being measured against.
Based on the dollar.
Yeah.
The second point, now I've sort of thought the problem with central banks is they really like to hold on to their gold. The idea of giving convertibility to unwashed citizens is actually furthest from their minds.
Yes. Well,
But the fact that they've opened up Shanghai, in terms of gold flows, Shanghai to Hong Kong, tells me that when they do put the yuan on a gold standard, it won't just be for trade settlement purposes. I think it will extend to the domestic currency. That is the logic, if you like, of the move of freeing up gold flows between Shanghai and Hong Kong, between the domestic market and the international market. This, I think, is very, very important. Now, the other thing I think, we must understand, and this is where everybody goes wrong, is it's not gold going up. I mean, obviously, there's some fluctuation, if you like, in the price, but it's basically our currencies going into the toilet. So the idea that gold at $4,000 is expensive or not expensive, and at $6,000 is expensive, is absolute rubbish. What you should be asking yourself is, our currency is going down. Has it gone down too much? Is it discounting too much in the future? In which case you sell gold by the currency, or not. And if you are generally worried, without being, let's say, too specific about currency risk, about credit risk in the wider sense, then the gold price doesn't matter. The gold exchange price between your currency and gold doesn't matter, because gold just goes along like that.
Yeah.
It's your currency that's sinking. And so this is, if you like, is why people should just stack the stuff and not try and double guess. It might come back $50 and I'll try and buy it a bit cheaper. You just miss it. This is just, the fact of the matter is that traders, they're like punters in a bookies. The bookie makes a damn good living. He really does. Yes. You might get lucky occasionally, but in the long term, you're going to damn well lose. So that is the answer. Don't look at the gold price. Just look at the value of your currency and make your decision, which probably won't be very well informed on that. This is it. And people just don't realize it. This is entirely consistent with a currency collapse, in that the last people to understand that it's the currency going down and not prices rising are the users of the currency. And the Austrian economists call this the crack up boom. It's basically the end of the currency is everybody getting out of the currency because they realize the currency is going down, and they will get rid of it just to buy anything. They don't care what it is. That's that crack up boom, if you like. It's the end of the currency. And that is the psychology that will persist until, you can say that, an ounce of gold will be $1 million or $10 million or whatever. I mean, it's irrelevant as far as gold is concerned. What is relevant is the collapse in the purchasing power of your fiat currency.
Yeah.
And then you have to ask yourself, is the Australian government in a position to put the Aussie dollar onto a gold standard? And that I leave to everybody in Australia to ask themselves, because I'm not going to answer that question for you, but that's the question you've got to ask. The moment China does it, can you go along with them? Or do you go along with the Americans? The Americans who have been supplying you with oil to suppress the price, for example. Those wonderful people, Five Eyes. My cynicism there is, they've created so many problems in Europe. I wouldn't begin to guess what problems they've created in Australia. But, I don't regard the Americans as being our friends at all. They pursue their own interests, not yours.
Yeah, I tend to think so.
If they put pressure on your government not to go along with the new Chinese monetary system, your politicians, when they say jump, they'll say, how high?
Yeah.
If they're anything like ours, anyway.
Nowhere is that currency stress more visible than in Japan. In January 2026, the 40-year Japanese government bond yield broke above 4% for the first time in its history, and the 10-year yield has since climbed to levels not seen since the late 1990s, with gross government debt sitting near 240% of GDP, among the highest of any major economy. Rising yields here don't just reflect inflation fears, they threaten to make Japan's own debt service genuinely unaffordable. Analysts remain split on just how dangerous this is. Some point to Japan's unusually domestically held debt as a stabilizing cushion, while others warn that the Bank of Japan's shrinking balance sheet leaves yields with far less of a ceiling than they had in the past.
It's basically central banks who understand the difference between money and credit. That's the answer. Incidentally, I think that figure for UK gilt yields is not correct. The highest it has been recently. If we're looking at the 10-year, we're looking at about a bit over 5%. I think currently it's just under 5%. We all have these sort of we can't get everything 100% right all of the time. So I think it's a minor point. The main point he is making is that bond yields are rising. Of course, this means that the value of a bond is falling. Now, to what extent the central banks are thinking, well, we don't want to hold bonds that are falling in value, we would rather hold gold, from the point of view of the fact that bonds are proving to be a very bad investment, I suppose varies from central bank to central bank. But the fact of the matter is we're in a bond bear market. And this is true of the whole G7, all the G7 nations. And the most obvious of this is Japan. Japan has suppressed interest rates at the zero bound for, I can't remember, well over 10 years before they sort of reluctantly had to let interest rates rise. And so far, they've suppressed them to the point where they've risen only 1%. This is the Bank of Japan's reference rate, 1%. The bond market is in crisis. Just look at the chart. It's like an exponential curve shooting up to the moon in terms of the yield, which means the bond prices are like an exponential curve shooting down into the ground. This is very, very bad news. The currency has come under great pressure. The fact of the matter is that Japan's government financing has run into a brick wall. And they just can't do any more. And this, of course, prompted an intervention by the Americans, where they sold some euros in order to trigger a bear squeeze, if you like, in the yen. Now, this is so far, it's beginning to unravel already. And I think that, it's created a lot of commentary, which actually has backfired on America, on the US Treasury. But the real purpose of this, in my view, was to, try and turn things round a little bit as far as the Japanese Bank of Japan and also the ministry is concerned, because they have run into a financing brick wall. As interest rates rise, as bond yields rise in Japan, their financing position gets even worse. Why? Because you've got an economy which effectively is going to stagnate. And I'll come to that in just a second. It's going to stagnate. And at the same time, you've got a 240% debt to GDP.
Yep.
So the idea that any increase in the government debt can be covered by increased tax revenues, etc., is completely false. Now, the reason that the Japanese economy is going to enter a state of collapse, I do not exaggerate, is that they depend 90% on their energy from more specifically for their oil and LNG energy from the Persian Gulf and the Middle East. Now, so far, what America has done is it's shipped tanker load after tanker load of oil from its strategic reserves over to Japan basically to keep Japan going. And some of it's come your way too, and also to Thailand, from what I can understand. But Japan has been the main recipient of American oil from the drawdown of its strategic reserves. Now, those reserves are running dry. Or when I say dry, it's going down to something like below 300 million barrels, which, according to all the experts, basically means if you take it much below that, the underground caves in which this stuff is stored will collapse or whatever, and it becomes unusable. So they are running out. And there's absolutely no sign of the situation in the Gulf improving and oil coming back from that region. And anyway, even if Hormuz and the Bab el-Mandeb Straits open tomorrow, it would take months to return to normality. I mean, months and months and months. The fact